Hey everyone, this is Mike Schmidt with Rothwell Growing Companies here to talk to you about being a first-time home buyer. I'm here to answer some questions that I've received from first-time home buyers that I think more people should know the answers to. How much money you need to buy a house depends on many factors. What's your credit score? What's the cost of the house? What kind of loan are you getting? Is it FHA, VHA, conventional? The first step you need to take when determining how much money it's going to cost you to buy a house is to first talk to a lender or a bank to determine what kind of loan you're going to get to buy the house. Do I need cash? What if I have money in my 401k? Can my parents give me a gift to buy the house? All great questions. The bank or the lender will be the one to answer those questions for you. Once your lender or bank gives you what's called a pre-approval letter, in that letter it's going to tell me as the realtor what loan you're approved up to and the parameters of that loan, how much percent you're going to need down. And then once we get those numbers, then we know when negotiating a contract if we're going to need maybe the seller to provide some money back towards closing costs, how much money you're going to need for houses depending on what their HOA is, or if there's a sitter lid, or if there's a master plan fee. All these things are factors into that final number. What if you want to buy a fixer-upper and do a remodel? Does this place need appliances? Are you upgrading from a one-bedroom apartment to a three-bedroom house and now you need furniture? It's a lot bigger equation than just, oh, you're buying a $300,000 house, you need 60 grand. I have a client that I've sold a house for $250,000 to, and they only needed to bring about $6,000 to the closing. Will that be the same for you? I don't know, because every person is different, every transaction is different, and the person that's going to answer that question best for you is going to be your bank or lender. What is earnest money? Can I lose earnest money? What is that money for? The best way to describe earnest money is it's money you put down at the beginning of the transaction that will be applied to cost you incur at the end of the transaction. How do you get earnest money back? Well, let's say we go see a house and it's perfect and we put in an offer and it's accepted. Right after we get an accepted offer, we'd have what's known as a due diligence period. In the due diligence period, we would hire an inspector to go through the house and check it out. If he finds something that needs to be repaired and the seller doesn't want to repair it, and you think that that is a cause enough to cancel the real estate transaction, you would get that earnest money back at that point. What if you lose your job in the middle of the transaction and you no longer qualify for the loan? You can get that earnest money back on what's called the loan contingency. What if we get to the very end of the real estate transaction and we go to do a final walkthrough and we find out that the seller had removed all the copper pipes and took all the appliances that were in the contract to be there? You would get the earnest money back when we cancel. How do you lose the earnest money? After all the contingencies have passed and you just decide to change your mind and you no longer want this house, you would lose that earnest money. It's rare. For the most part, you don't have to worry about that. Finding the right house for you. That to me is the funnest part of buying a house, because we get to go into every house that's available in your price range and see, does this feel right? Do you want the kitchen to be a part of the living room? Do you want walls separating everything so you have your own spaces for everything? Do you want one big giant open space? What kind of yard do you want? Single story, 2-story, 3-story? Do you need a garage? Do you want a 3-car garage? All these questions you might think you know an answer to and you might have a preference for, but once we go out and start looking at houses, you might change your mind or find the perfect house that is nothing like what you thought in your head was going to be the right house. Location. One of the common questions that I ask my clients is, where do you work and where do you want to live? What time of the day do you work? Are you going to be driving into the sun every morning and driving into the sun every night on your way home? Where do you like to hang out? Where's your gym? What is the drive going to be like? Is there a school zone next to this house? There's a lot more questions than just saying, I want to live next to the highway on the southwest side of town. Finding the perfect house that's the perfect blend of your needs and your wants. Okay, we found the perfect house. Now what? Okay, the first things up is the due diligence period. We hire an inspector, goes through the house, and he looks for anything that we might not see, that we don't know is an issue. Whether it's plumbing, electrical, something with the roof, maybe there's a mold situation. It could be anything, or nothing. If he finds something, we have what's known as a chance to do a repair request, where we ask the seller to repair some of the issues that we didn't see upon our first viewing. Or we ask them to give us more money back towards closing costs and we'll do the repairs ourselves. Or the seller decides he's not going to give us money back and he's not going to do the repairs. You have an option to back out of the deal and say, you know what, the house looked great, but underneath the facade there was a lot of issues and I don't want to buy this house anymore. You get your earnest money back. The only thing you're out is the cost of that inspection. Generally it's around $200 to $300 depending on the size of the house, if there's a pool, etc. The appraisal. The appraisal process is where the bank sends someone out to the property to make sure that the house is worth what they're giving you a loan for to purchase the home. That process can alter the sale price of the house. How? Well, let's say you're buying a house for $210,000. The bank does an appraisal and they say that the house is worth $215,000. Well, what does that change? It doesn't change anything. What they're saying is they think the house is worth a little bit more than what you're buying it for. And that's good to know. But it doesn't change what the purchase price of the home is going to be. What if the appraisal comes in at $208,000? Well, that's $2,000 less than they're willing to give you a loan for. So the loan is only going to be up to the $208,000. But you agreed to buy the house for $210,000. Where does the other $2,000 come from? Well, it could be that you pay the additional cost and that $2,000 is added to your down payment closing costs. So whereas before you might have needed $4,000, now you need $6,000. Or we have the seller say, listen, we thought the house was worth $210,000, the bank doesn't agree, sell us the house for $208,000. No harm, no foul, they make $2,000 less. What usually happens is we split the difference with the seller. We say, we wanted to buy the house at $210,000, the bank says it's worth $208,000, you come down $1,000, we'll come up $1,000, we'll buy the house for $209,000. So instead of $4,000 at closing, you need $5,000 at closing. That's usually the most common thing that happens with a low appraisal. Mortgage payments. When do you pay your first mortgage? When you close a house, built into the closing cost is the first month's mortgage. So if you were to, for example, close on a house in January, you would skip the February payments, which is already rolled into the cost of buying the house, and then you would start paying your mortgage in March. Thanks for watching, and if you have any questions, please leave a comment, give me a call.